Hello and welcome to Big Deal. Today we have with us Neeraj Bharadwaj of Carlyle right here with us in our studios. Neeraj, so good to have you on CNBC TV 18. The first question, you head the buyout fund for Carlyle here in India and that has made some significant investments. What is the total portfolio looking like and what is your investment thesis here?
Thank you for the opportunity to be here. We've invested about 1.4 billion across all the Carlyle funds in India, and currently we have a buyout fund, which, as you mentioned, is what I head up, which is focused on larger transactions, and we also have a growth fund, which is focused on smaller transactions. So I think if you look at the thesis right now, maybe it's worthwhile to give some a perspective on Indian private equity over the last decade, because in that context we can talk about the future. I think if you go back to 2007, when India's GDP growth was at the 8-9% level, people believed that India would be the next China. And so there's a significant influx of capital in 2007-08. But post that period, we hit the global financial crisis. We hit a period when India's GDP growth was about 4.5%. And so most of the investments from that time period, also in the context of currency depreciation, haven't done well on a dollar return basis. Now, fast forward to today, the macro is much stronger. The belief that India will actually deliver. India's return on capital is actually the highest in the world. So today, incremental return on capital in India is about 24%. The global average is about 11%. And so the excitement about India as an investment destination is much, much higher today. And in that context, when we look at our investment thesis, it's really predicated both around domestic consumption, which is 70% of India's GDP, as well as export-oriented sectors. And we can talk more about that because those are the two large pillars of India's GDP growth.
All right, we'll get into the specifics of that, but you just made an exit in the equities markets. Of course, valuations are looking quite hot at this point, and you did exit your 8.2% stake in Edelweiss at threefold returns as per our calculations. So you're happy with the returns, but also market valuations on one side and rupee, the way it's strong on the other side, that sort of brings down the overall returns.
So I think, India has never been a cheap market. In India, valuations are always fully baked to close to being fully baked.
But you still make money.
You still make money, I think, and which is why private equity funds are still investing. So if you look at our business model, it's about finding the best company. We like certain sectors, we don't like certain sectors, but within that, our model is finding the best promoter group, the best management team, and the best company. Ours is a very micro-focused business. And so it comes down to identifying that right company and being able to work with them. So if you look at valuations today, if you look at the Nifty 50, it's trading at about 18 to 19 times forward PE. Now, this has to be viewed in the context of a 17 to 18% earnings growth. And if companies can achieve that, and if the index can achieve that, then the valuations get justified. On the other hand, if you get in at a high valuation, but then your company only grows 5-7%, then obviously it won't work out. Rupee is actually very interesting. If you look at the period from 07-08 onwards, till recently the rupee went from 40 to 65. And on a long-term basis, the rupee should appreciate versus the dollar because there's an inflation and interest rate differential with the US. I think what has happened in this particular point in time is, given the interest in India, given fund flows in India, given some uncertainty around the US, the rupee has appreciated. But on a relative exchange rate basis versus a basket of currencies, it is actually overvalued. So it is hard to predict. I think it's more of a temporary phenomenon, but it's not something which we focus on. We are ultimately long-term investors taking a long-term horizon. And so we're not really as focused on the month-to-month currency fluctuations.
All right. So Carlyle invested 1.4 billion in total in India so far. What is the outlook going forward? How much more can we expect? And given the current market valuations, are you investing? What is your investment scenario looking like at this point?
See, I think as I mentioned earlier, we're very bullish on the investment scenario. Maybe I'll just talk a bit about that and then get into specifics. And there are four reasons why we're positive, right? One is, I think, if you look at the macro situation, it is actually much stronger now than it has ever been before. Fiscal deficit in the 3 to 3.5% range versus a high of 5.5 to 6% 5 or 6 years ago. Current account deficit is 0.8 to 1%. It was 3 or 4% earlier. Inflation down to 3.5 to 4% from 8 or 9% earlier. As you said, the rupee appreciating versus a period where analysts were predicting rupee going to 90, maybe 2 years ago, right? So I think in that context, so the macro is very strong. You're viewing GDP growth of 6.5 to 7.5% in that range, which is very positive. You have political stability in the country and a willingness to drive change, which is very positive. I think you have promoters who have got more accepting of private equity. Ultimately, this private equity is a bit like a marriage. It's not exactly like a marriage, but it's close to marriage where you're in partnership with the promoter group, and you have to understand what each other wants. I think in the early days of private equity in India, it was a new asset category. The rights people wanted, the style of operating was foreign, and there were some wrinkles which need to be ironed out. I think all of that has been sorted out today. If you look at IPOs today, in the last 18 months, 80 to 90% have actually been private equity-backed companies. So even the market, and also promoters, but even the market is willing to reward companies which are coming with private equity backers.
So Neeraj, even though your fund is called a buyout fund, but you haven't really done many buyout transactions. Why is it so? Is Indian market not mature enough?
It's a great question. I think our focus is doing larger deals. So we have a minimum check size of about 75 million. And then we want to invest in the best company, whether it's a minority transaction, a significant minority transaction, or a buyout. As you said, I think the Indian market is becoming deeper. So as a percentage of deals from our perspective, maybe 3 or 4 years ago, buyouts as a percentage of overall deal volume was about 10%. Now it's maybe inched up to about 20%.
Yes.
I think the main reason why there haven't been more buyouts is that promoters are quite optimistic about the Indian growth scenario. And buyouts tend to come in a model where either the promoters want to take a back seat or they have got disillusioned about their company's prospects. Having said that, I do think there'll be more buyout opportunities moving forward for a few reasons. One is, as some promoters do want to cash out, in certain situations there are succession issues, generation issues, and so that leads to a buyout deal volume. I think also some of the larger business houses in the country have started to core down on their main portfolio, so that sometimes gives an opportunity to buy assets from them. And thirdly, you have multinationals who maybe earlier had come into India but now want to exit, and that gives you an opportunity to buy into those controlled deals as well.
So all these options are available, and you will be looking at more buyout opportunities now?
Yes, yes. As they come along, we will definitely look at it, but I don't think we want to wait for them to come along to do our deals. We will want to, our model is backing the best promoters and management teams, and whether that comes in the context or construct of a minority deal, we'll do it, or if it comes in the construct of a buyout deal, we'll also look at it.
But Neeraj, overall Carlyle has over $150 billion of assets under management worldwide, and we have only 1.4, which is a very small amount compared to what you have worldwide. So is that kitty really going to increase since you are sounding so bullish on India?
See, I think if you look at it, the 150 billion is across different asset classes, private equity, real estate, distressed assets, which we can talk about later. So I think in the private equity context, I think the Indian scale, the Indian market in private equity has only come of scale recently. It is challenging to invest ahead of where the market opportunity is, because then you end up doing deals which are not so good. I think what we fundamentally believe is, from where we look today, we're very bullish on the Indian scenario. And if the political stability, the motivation to change, and frankly, if private sector capex picks up, this is an economy which could deliver 8, 9, 10% GDP growth, not for a few years, but a sustained period of time. This could be where China was in the 1990s. And you've seen the value creation which happened there over 20 years. That could happen in India as well.
So many private equity funds have really taken the opportunity of good valuations in the stock market, and there are at least 4 large transactions that have taken place in the last 10 days, including yours, where you exited Edelweiss. So these are good returns that you're seeing. Is the exit from private equity funds, that's going to be the trend going forward in these heated markets? Or do you think that investments at these levels are also equally good?
See, I think it's a two-part question, right? So one is, if you look at the context of IPOs, a company which is IPOing today has started preparation 12 to 15 months ago. I think that what has helped is, one is SEBI, the process with SEBI has actually become very streamlined. So what earlier used to take 12 to 18 months is now actually happening in 6 months. I think secondly, as the optimism around India has increased, there are more investors, domestic and foreign institutional investors, who want to buy into India. So the IPO window is something which is more attractive today than it was 2 or 3 years ago. Our business model is predicated, once we enter, we do need to exit at some further point in the road. We look at secondary sales to other PE funds, we look at IPOs, we look at M&As, but we work in conjunction with the promoter and the management team. Not everyone wants to go public, right? A lot of people do want to go public, but there is a minority of people who don't want to go public. So it is very opportunity driven, trying to find, along with our partner, what is the right exit mode.
All right, hold your thoughts there, Neeraj. We'll talk more about sector specific and where your interests lie in the other segments. So stay tuned to Big Deal. We are going to talk a lot more about Carlyle's investment destinations in the next segment.